Hello everyone and welcome back to the world of finance. For CFA Level 1 students, the subject economics, the last two chapters of economics are dedicated to foreign exchange basics. So at level 2 and level 3 later on, you are going to experience foreign exchange risk management and other issues. But let us deal with the basics of foreign exchange, which begins with the term exchange rate. Now, what is the term exchange rate exactly? See, when you want to exchange two different currencies with one another, at what rate these currencies can be exchanged? Or suppose you want to buy a particular currency, at what price you can buy that currency is called exchange rate. So if I give you a simple notation, how do you interpret this quote? Now this is to be read as INR per USD. Now what happens? Many people get confused when you make generally a Google search. You generally type USD space INR, which will give you quote of USD in terms of INR. But in your examination, the formal way of expressing a quote is always going to be INR per USD. It indicates what? INR per USD. In other words, if you need to buy USD, how many INR you should pay? In other words, you have to understand that you are trying to buy a particular currency and the price of that currency should be known in terms of the other currency. So when we write INR per USD, mathematically it should be presented as INR per USD. That means one of the currency in the numerator, another currency in the denominator, and this represents the exchange rate. So INR per USD as a 95.20, it indicates that 1 USD is equal to INR 95.20. Now, what exactly is this in the equation format? USD1 equals to INR 95.20. Now, all these have one common understanding. It is a quote of 1 unit of US dollar in terms of Indian rupee. So, basically, the numerator in the quote is called the price currency. The denominator in the quote is called base currency, and this 95.2 is typically the exchange rate. Quote is always for the base currency in terms of price currency. So if you are listening to this for the very first time, it may sound a bit confusing that what is this base and what is this price. I'm going to give you elaborate and clear understanding on what is base currency, what is price currency, how do you identify in a quote which is the base currency, which is the price currency, why you are calling these as base currencies and price currencies, everything unfolded just as a part of this video. And now I would want you to quickly take note of this in case you are willing to, and then I directly take you ahead. So once you have taken note of this entire thing, let me take you little deeper. So here in this exchange situation, you are trying to exchange two currencies, US dollar with Indian rupee. So US dollar and Indian rupee, these are the two currencies present in this equation, and the equation highlights USD1 equals to INR 95.20. So 1 unit of USD is equal to 95 Indian rupees. That means this indicates that you are trying to either buy or sell 1 unit of USD, because the price is given for 1 unit of USD. Price is not given for INR, price is quoted for USD. So price is quoted for USD, so USD becomes the base currency. Let me simply tell you, if I want to buy this remote control, then this becomes the commodity, and suppose the price of this is rupees 800, then I have to pay rupees 800 to buy this remote control. Then remote control is the commodity, and the money that I am paying, 800 Indian rupees, that will be the price. When I am buying a dollar, its price is rupees 95.20. So 95.20 is the price of 1 unit of dollar. So understand one thing very clearly. US dollar, Indian rupee, both are currencies, both are money. But when 1 unit of US dollar is quoted in terms of INR, it behaves like a commodity. Though it is money, but it behaves like a commodity. The moment it behaves like a commodity, it becomes the base currency. You call it base currency because in this whole transaction, the base for which the price is quoted is US dollar, and price is quoted in terms of INR. So INR is the price currency, USD is the base currency. So imagine this way, you go to the exchange dealer who has quoted 1 USD in terms of INR. So USD is behaving like a commodity and the price for that is quoted in terms of Indian rupee. So imagine US dollar is something lying with the exchange dealer that you want to buy, and the INR that you have to pay in exchange is the money in your pocket. So whatever behaves like money is the price currency, whatever behaves like commodity, it is the base currency. Quote is always given for the base currency in terms of the price currency. So I'm sure you are clear with this explanation, and let me take you deeper into the explanation of what exactly is base currency, and let me expand the screen size for your reference. So base currency, currency you want to buy or sell that behaves like a commodity. What is price currency? Currency you pay for buying the base currency, or currency you receive by selling the base currency. So price currency behaves like money and base currency behaves like commodity. So in more clear terms, what is base currency? When you buy a currency, that currency behaves like a product or item that you are purchasing. Price currency, the currency that you pay in exchange, behaves like cash in your wallet. Alright, so after taking note of this, let us move on to the next part of our discussion. So in this example that we have been taking, INR per USD is 95.20. We have already identified that INR is the price currency. This behaves like money, and USD is the base currency that behaves like commodity. So everything that I have displayed over here on screen, we have already discussed. Now numerator is the price currency. Now that is going to be domestic, and denominator, that is the base currency, that is going to be the foreign currency. Now why we are introducing these two terms, domestic and foreign? Imagine yourself as an entity operating in India. If you are an entity operating in India, you may be importer or exporter, and therefore you would want to either buy or sell a foreign currency. For example, if you are an importer and you have an obligation denominated in US dollar, to settle that obligation, you will have to buy US dollar to make the payment. So to buy US dollar, for you, US dollar is a foreign currency, which will be always the base currency. And for you, Indian rupee is the domestic currency, which will always be the numerator or the price currency. Now, this quote, let me expand the screen size for you. This quote, USD is priced in terms of INR. So INR per USD, it is a quote of USD in terms of INR quoted in India. So you may take note of this, and once you have taken note of this, let me show you something beyond. Now, in India, USD is the foreign currency and INR is the domestic currency. So if you observe this quote is of USD in terms of INR. So this quote is for 1 unit of foreign currency in terms of domestic currency. That is why it is called a direct quote. So let me give you a conceptual line over here. When we speak of exchange rate quotations, we will always encounter two types of quote, direct quote and indirect quote. What is a direct quote? In case of a direct quote, 1 unit of foreign currency is expressed in terms of the domestic currency. 1 unit of foreign currency. So again, if you look into this exchange rate quotation, INR per USD. The base currency is USD, which is behaving like a commodity. For an entity in India, USD is the foreign currency, correct? So if USD is the foreign currency, it is a quote of 1 unit of foreign currency expressed in terms of domestic currency. Now I am asking you a question. If USD 1 equals to INR 95.20, how much will be INR 1 in terms of USD? Because for an entity in the USA, INR will be a foreign currency and USD will be the local or domestic currency, correct? They will have exchange rate quotation inverted. So one simple point is, if INR per USD is 95.20, USD per INR will be reciprocal, means it will be 1 divided by 95.20. Let me show you. USD per INR is 1 divided by 95.20. Now, when we write INR per USD, it was a direct quote for an entity in India. For Indian entities, INR per USD will be a direct quote. Likewise, when we write USD per INR, and if this is a quote given for an entity in the USA, it will still be a direct quote, because for the entity in USA, what is going to happen? INR is the foreign currency and USD is the domestic currency. If this quote is offered in the USA, it will still be a direct quote, correct? So if you understand one thing, internationally 1 USD is equal to INR 95.20. Now where is this quoted? Quote of 1 USD is given in India, that is quote of USD in terms of INR, and quote of INR is given in USA, that is 1 unit of INR in terms of USD, but its value will be reciprocal of 95.20, that is 1 divided by 95.20. However, if this same quote is given in India, then it will be called an indirect quote. Let me just show you this. So same quote, USD per INR, it is 1 divided by 95.20. If this quote is offered in India, it will be an indirect quote. So you can take note of this and then we move ahead. Alright friends, once you have noted this, let me explain to you something very, very important. If you observe both of these expressions, both are exactly same, right? Both are exactly the same. But one time you are writing this as direct quote, one time you are writing this as indirect quote, depending on where is this quote offered. So you can understand one thing, foreign currency and domestic. Foreign and domestic are not two independent entities. You will call foreign or domestic depend on where you are operating. So let me give you some important points over here. The direct quote or indirect quote depends entirely on which country is making the quote. So same example, USD per INR, if it is offered in USA, it is a direct quote. But same exchange rate, if it is offered in India, it becomes an indirect quote. So keep that thing in your mind. This direct and indirect quote is never to be looked into on absolute basis. It has to be looked into based on which currency is the domestic currency and which is the foreign currency, and which country the quote is being offered. So if you observe one thing, you will not find in India Indian rupee quoted everywhere. For example, in India you go to any exchange dealer, they will give you list of all the foreign currencies, and foreign currencies like USD, GBP, EUR, SGD, AUD, ZAR, all these currencies will be quoted in terms of Indian rupee. So all these are foreign currencies. There is only one domestic currency, that is INR. So all of these currencies which are quoted by the dealer, all these are base currencies and all are priced in terms of INR. So do not forget that if these quotes are given in India, these will be having all these foreign currencies as the base currency, and commonly INR as the price currency, which will be in the numerator. So let us write down these important points as well. So domestic and foreign are not permanent identities. They change with the country making the quotation. In a direct quote, one unit of foreign currency is expressed in terms of local currency, and in an indirect quote, one unit of local currency is expressed in terms of foreign currency.